Welcome back. Jonathan Garner joining us now, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley. Jonathan, good to have you with us, and good morning. Lots to talk to you about. I want to just dive right in and discuss the kind of earning revision trends that you've been looking at, and really where India stands right now. Everyone's been trying to make sense of the market economy dichotomy and figure out exactly where we stand. How are you assessing the current situation based on the kind of earnings and commentary that we have been seeing?
Well, I guess if you look across our coverage, what's very noticeable by market is the way that the earnings estimates in Northeast Asia, particularly in China, Korea, and Taiwan, have turned up more rapidly and to a greater extent than those elsewhere in our coverage universe. In India's case, there is an improvement, so earnings revision spread has troughed. It's more in the middle of the pack, and what we're really observing is that Latin America, in particular, is lagging, and that's reflected in underperformance of Latin America.
Okay, so given that you are seeing some improvement, Jonathan, and the fact that we continue to see fairly strong liquidity, post central bank action globally, do you see Indian markets continue to trend higher from here? Is there enough interest opportunity as you see it, or are valuations starting to look overpriced?
Well, again, it's in the middle of the pack. In terms of our recommendations, we're sitting on an equal weight recommendation right now. We could see an index level on Sensex of around 40,000 again if all goes well. But we actually have had and continue to have more upside, particularly for the China equity indices and most notably the A-share index. One of the things we're monitoring is liquidity, as you mentioned, and retail investor sentiment. And when you look at account openings, margin, futures trading, broad money growth, that is stronger again in China and in Korea than what we're seeing in India, let alone parts of Latin America and East Europe, Middle East, Africa.
Sure. In terms of reform, structural moves, perhaps from the government, is there anything else that you would have liked to see from India? There has been so much talk of India taking advantage of the current tensions between US and China. But as you have just described as well, Chinese markets continue to, of course, be front and center when it comes to this part of the world. What more could India do, or what more would the market or experts like to see in order to really create more traction back here?
I think one of the key things that we've been consistently emphasizing in recent years is credit creation. In terms of getting the public sector banks into better shape, there has been some action, but we also had a kind of a shadow banking credit crunch in India, which is only partially ameliorated. It's really important for the overall economy and earnings to move forward that you have a more stable and persistent source of credit to businesses and households, and that is probably the single most important thing. It's not to underestimate what's been done in terms of making India more accessible to foreign direct investment, for example, and portfolio investment. These are important developments, but I think it's that stability of the financial system that is crucial.
Okay. Jonathan, while we have you, the consensus, seems to be, or from what I'm picking up this morning, that while markets globally are on this trajectory, we might see, a risk of a sharp fall, perhaps in the fall, closer to October. What are the kind of risks that you see? I mean, you talked about China. Even there, there are concerns that we might see a sharp fall, not just a correction, given the speed at which things have run up. Do you feel that there are certain, risk factors that need to be kept in mind here?
Yes, there are. We've got a a US presidential election cycle, and the market in the US can be weak in the 2 or 3 months running up to that, and that will be obviously in November. We have gone through obviously a very sharp recovery in markets, so it's really important to monitor whether earnings do come through. There's good news in that sense that US and European earnings cycle has begun relatively well. And we obviously have US-China tensions. And again, that needs to be monitored very, very closely. But yes, we have come a long way in a short period of time, and markets for the overall EM index it's around about 4 or 5% above our index target. So we're certainly not in an environment where we would be recommending it as a strong buy right now.
Jonathan, what could run a risk for India? Because we are seeing sporadically some states enter into miniature lockdowns, if I can call it that. Do you see that as a risk? And could that really pose a threat to the 14,000 target that you've set out for the Sensex?
Well, yes, it certainly could. In terms of lockdowns and interruption to economic activity, we're monitoring that very carefully. And again, whilst the nationwide lockdown has stopped, not just in India, but in most geographies, we are seeing this very divergent pattern in terms of COVID new cases and, pressure on the economy and indeed on the consumer. And again, broadly speaking, Latin America, East Europe, Middle East, Africa, and South Asia are performing less well than Northeast Asia. And again, that's a very pronounced difference in relation to COVID. Yeah.
Jonathan, if I can, just pick up on the point that you were making about the impending U.S. elections. What one is seeing peculiarly right now is the dollar weakness play out, especially in dollar-linked assets. Talk about precious commodities with gold hitting a 9-year high, silver at a 7-year high already. Do you see the dollar weaken further as we approach closer to U.S. election, or are the two not linked?
We certainly have been arguing for a weaker dollar, particularly against the euro. We've had this Eurozone Recovery Fund, which we think is a very important structural development. And the dollar is obviously affected by Fed policy, I think, more than the U.S. election cycle. If you look at long maturity real interest rates in the U.S. from the TIPS market, what you'd see is that at the 10-year maturity, real interest rates are around about minus 90 basis points. And those real interest rates are going further into negative territory. So that's telling you that the market is expecting the Fed to be even more stimulative. And that's in the face of an uncertain growth environment in the U.S. And that is likely to weaken the U.S. dollar.
Jonathan, it is said that every cycle and every crisis creates a new opportunity. But what we've seen in global markets and local markets is that the previous winners have only become the outperformers, which is US tech companies, Indian consumer companies, selective private banks. Do you think the trend of this mega cap concentration is a global phenomenon, and it's a phenomenon which will last for next couple of quarters?
Certainly, we've been looking at that. The momentum factor is exceptionally strong globally, so you're right to highlight that. It turns out that many of the business models that were already doing well, particularly in the e-commerce internet space, for example, selected consumer businesses, they are doing even better in this work-from-home environment. So I think it's important, however, to monitor valuations. If you look at growth stocks relative to value stocks, they're pretty well at all-time high valuations. So that snapback to value stocks in industrials, energy, materials, the diversified miners, and overall financials, that will be linked to how strong the economic recovery may be as we go through into 2021, and in particular whether that point I just made about negative real rates reverses. Once you get rising real interest rates, that typically would help value stocks do better, and you might get some rotation out of growth stocks.
Given Jonathan, right now there is a global narrative which is against China. Do you think global investors now could relook at reducing their weightage towards Chinese equities in general? Because for global investors who follow MSCI benchmarking, China has a very large position. But frankly, the narrative for Chinese manufacturing companies, Chinese internet companies, Chinese banks is not all that great.
Well, if you look at global investors, they've actually been reducing their underweight on China in recent months. In fact, they are less below benchmark than they have been at any stage since 2009, and that's related to the better economic performance and better earnings revisions patterns that we're seeing. So in that sense, investors are not expressing a significant concern on US-China tensions. However, we recommend exposure to A shares, where foreign investors are much less of an important feature of trading volumes, rather than the US-listed ADRs, which would be more at risk if there is a further escalation of US-China tensions.
Your time, and thank you for joining us, and thank you for accommodating this interview request. Let's take a break.